Welcome on board, Gautam Baid, the equity advisor, Complete Circle, Stellar Wealth PMS, joining in on the show right now to throw some fundamental sense on what really is going on with the global rout and how much of a damage could India actually see. Gautam, hi, afternoon. Sharp bounce back today in the markets. Is it just a technical pullback and is there more correction on the way, or do you think it was just a knee-jerk reaction that we saw yesterday?
Generally, such wild moves in intraday volatility and such wild moves in the markets do not get over in just one single day. We still have a lot of global risks to contend with, including the impending war in the Middle East and what impact that may have on the commodity markets and the global financial markets. So it's too early to write off this event of the last 24 hours as having passed us by. I think this is the time to be very vigilant and be very, very careful about the quality of the stocks that you're holding in your portfolio and to be very, very risk averse and to just keep a razor sharp eye on those stocks which are having very strong earning visibility, because those are the stocks which will bounce back the fastest the moments the market stabilize. But I think we are a few days or a few weeks away from complete stabilization of the financial markets globally.
Okay, so we haven't stabilized yet, and perhaps there could be a bit of a correction which continues, and the volatility that might continue. Gautam, hi, this is Anish also joining in the conversation. The market is essentially right now dancing to the tunes of rate cut expectation, right? What do you think is the possibility of an emergency rate cut? Because that was being rumored to be happening, though of course there's no official confirmation on that. And overall, what's your rate cut expectation for this year? Because a lot of people are talking about 3 to 4 rates, quantum anywhere between 75 bips to 125. Which camp do you belong to?
Well, the Federal Reserve, there's a saying on Wall Street that the Federal Reserve decides on the quantum of the interest rate hikes, but the markets decide the quantum of the interest rate cuts by the Fed. So I think, right, if you just observe the Fed fund futures market, which gives you the summary of the market expectations, the broad markets are expecting a 50 basis points cut at the September meeting, followed by another 50 basis points cut at the November meeting, and a further 25 basis points rate cut at the December meeting. So I would rather just go by what the collective wisdom of the market is saying at the moment. Of course, this is a very fluid situation. And if the global macro worsens very sharply, we may see the Federal Reserve, overreacting on the downside as well. The Federal Reserve never acts, in a very stable way on either side. They either overshoot on the upside or they overshoot on the downside. And either in both the cases, they're often too late. So I think the Federal Reserve generally tends to cut interest rates very sharply when the financial system breaks. So something has to break in the financial system worldwide. Then only the Federal Reserve really steps on the pedal and cuts interest rates very sharply. So let's be very careful what we wish for. I think it's best to hope for an orderly reduction in interest rates, because even if the Federal Reserve panics and cuts interest rates very sharply, that will also be taken as a negative by the market, because then the markets will think that the developed world, especially the US, is going into a very deep recession.
Okay, that point is taken. But Gautam, you've been an ardent follower and a student of Warren Buffett. What do you make of the recent portfolio changes that he has done, taking the cash pile to the highest ever? And I think this was the quarter where he sold the maximum amount of equity ever. Anything that we should read through from that?
Well, any student of Warren Buffett will tell you that Buffett does not time the market or take cash calls based on the market levels. He's simply finding a lack of opportunities to invest in the public markets of the West, because most of the good quality high growth stocks are very expensively valued. And Buffett just likes to wait for a bargain. Like when he bought Apple in 2016, that time the company was trading at a P multiple of 10x, excluding cash. So Buffett was able to buy a very high quality consumer branded business at a very cheap price. So, and he made a big amount of profit on that particular trade. And the moment he was able to get a very smooth exit in such a mega cap company during a period of market euphoria, he cashed in his chips. And now, just a very interesting piece of trivia for you: Berkshire Hathaway and Warren Buffett today hold more US short-term US treasuries than the Federal Reserve holds them. He is holding $277 billion of US treasuries, whereas the Federal Reserve holds only $125 billion of US treasuries. So Berkshire Hathaway is now a major player in the US bond market.
Right. Gautam, coming back to India then, can we truly decouple ourselves from what's happening across the globe? And if so, what are the big themes to look out for?
Right now, it's better to look inward and focus on the domestic economy facing companies and those companies which will benefit from the rising aspirational middle class as well as the expected good monsoons in India. I think if you just simply look inward and focus on the structural long-term bets which cater to the aspirational Indian consumer and also benefit from the rural stimulus being given by the government, I think we should be in pretty good stead. So there are many pockets of value which will emerge if you just simply focus on long-term themes. For example, transmission is a very long-term theme given the emphasis on power. Data centers is a very promising theme as well. In the rural side of the equation, two-wheeler stocks. I'll give you some sample names. We don't hold this in our Complete Circle Stellar Wealth PMS or Stellar Wealth Partners India Fund, but these are just for discussion purposes. Companies like Fame Industries, Lomax Auto, ASK Automotive, all these companies primarily cater to two-wheeler industry, and they are seeing a sharp increase in their top line growth after many years of a downturn in the two-wheeler segment. Domestic agrochemical companies, if you look at the results of companies like Sharda Cropchem, Sumitomo Chemical, and Dhanuka Agritech, all these domestic agrochemical companies are giving you very strong guidance about their future growth for the next 1 to 2 years. So I think these are the pockets to focus on. They are under-owned, they are under-researched, and even a small amount of buying by institutions can lead to a very sharp rise in the share prices of these companies. We do not hold any of these agrochemicals players. We hold a different name in our PMS, but I think these are the pockets to focus on.
Right. So, Gautam, what's the best tactical trade right now across all global assets, according to you?
I think if if we can short the CBOE VIX or the volatility index in the US, that will be a great trade. Unfortunately, there's no way to short that particular index, but that is such a volatile index at the moment that will give you a lot of trading opportunities both on the upside and the downside. So that is one instrument I wish I could trade. Else, I think gold looks pretty good from a long-term perspective. Given the rising global geopolitical tensions, I think gold should do well, especially in INR terms because of the depreciation of the INR versus the US dollar over time. I think gold should be definitely have some allocation in your overall asset allocation.
Those are the themes and the best tactical trade. But if you had to book some profits in India or take some money off, which is a good trade right now, where would you book profits from?
Not book profits on valuation alone, but I would definitely start booking profits the moment any of these highly expensive pockets start showing either of two things, either a drastic reduction in their operating margins or a sharp slowdown in their top line growth. That is the moment I would take profits off the table in all these expensive valued areas of the market. But history and experience has taught me that in India, as long as the company is growing at a very fast pace with increasing or stable margins, till that time the valuations do not come down. They actually keep expanding over time. It's only when the growth rate starts slowing down or the margin reduction takes place, that is when the de-rating process starts. So you just keep a razor sharp focus on those two parameters.
Okay, Gautam, thanks so much for making time and speaking with us. Always a pleasure hearing your views. So that's the word coming in, that perhaps the correction is not over. The bout of volatility will continue, but India is definitely one space which could not decouple, but definitely it's time to look inwards. And there are a lot of themes like power transmission, data centers, even some agrochemical plays in autos, two-wheelers, etc. that might make a good bet right now.
If you like this video, then like, share and subscribe to ET Now.